that inversion of the yield curve where short rates are higher yielding than long rates is almost always a precursor of recession. Also then coming out of that, when the yield curve starts to uninvert and be positively sloping again like it is now after the last 90 days, that is typically a sign that the recession has begun. Okay? I'll tie this back together to that forecast I mentioned earlier. The reason why I thought this would be such a great year for the precious metals and why I said it's the best year since 2010 is I thought it looked a lot like 2010. Because in 2010, we were coming out of the financial crisis and everybody was talking about green shoots and economic recovery, and QE was this one-off thing for $600 billion, never to be done again.
Welcome back to Finance and Liberty and Reluctant Preppers. We have a returning guest, Craig Hemke, the founder of the TFMetals Report, is here with us again. Craig, thanks for joining us this Monday, November 11th, 2019.
Hey, happy Veterans Day. Down again, celebrating the end of the war to end all wars. That didn't work out too well.
But we do appreciate the sacrifice of all of our veterans, as much as we sometimes question some of the reasons that they've been put in harm's way.
Yeah.
But just wanted to thank them for their service. And
no doubt.
Having you back, the last time we had you on was near the middle of third quarter. We were talking about how gold had broken out of like a 6-year trading trough to some recent highs, and then it's been struggling since then. Some people have said it was overbought. Some people have said that it's encountered severe resistance, intentionally beating it down at opportune moments. And you've tweeted about that on a recurring basis. Can you kind of give us walk us through from the August gold high? What was going on in that time of year, and what are we seeing now in the macro picture that could be affecting that?
Well, both of those points that you mentioned earlier are correct. From the technical standpoint, it had gotten pretty overbought, which just means you kind of had extreme sentiment, and usually markets move contrary to what the sentiment is, and the sentiment was really, really bullish and excited and all that kind of stuff, and that's usually a sign that everybody that's gonna buy has bought, and at that point, you get more sellers than buyers in anything, and so we kind of got, I had written and you and I discussed back in January that I thought this was going to be the best year for the metal since 2010 for a number of reasons. And that was kind of outrageous to say that because, as you said, we'd gone 5.5 years unable to get above 1350. And so to all of a sudden, stick my neck out and say this was going to be a great year was kind of contrarian too. I thought we'd get to maybe 1480, 1520. By the end of the year, and as you said, we were there in August. We got to 1560 or something in August. So yeah, it was overbought, and it was also a little ahead of schedule. Needed to kind of pull back a little bit, and that's what we've since seen. More importantly, though, I think what has really kind of driven this drift lower is a turnaround in global interest rates. And this is probably something that we should discuss because this is if you enjoy the precious metals, if you like to buy them, if you're looking for opportune times to buy them, everybody wants to buy them, less expensive. You want to save money, right? So you want to buy them when they're low or dipping, that kind of thing. What has happened since the end of August is a turnaround in global interest rates. We went from the beginning of this year having about $8 trillion worth of global bonds, government and corporate bonds, that had a negative yield, which in itself is outrageous. But by August, we got to 17 trillion. Okay, so this is like just going like crazy. And negative interest rates are really the greatest fundamental rationale for physical metal ownership that's ever been created by mankind, because everybody says, well, don't buy gold, it doesn't pay a dividend, right? Well, no dividend beats a pants off of a negative dividend, right? Where you got to pay the bank to hold it for you. So anyway, we reached this peak all the way up at 17 trillion. Well, now that's all the way back to 12 trillion. The U.S. 10-year note got all the way down to 1.45%. It's now back up to 1.95%. And so it's this move in interest rates that has really been the driving factor of gold kind of rolling back from this overbought condition, that kind of thing. So what we're going to want to watch as we get into 2020 is this direction of interest rates. We had a similar situation to this happen in 2016, where the amount of negative debt went to 10 trillion in the summer of 2016. And the 10-year note went to 1.5%. And then all of a sudden, that all turned around and gold got smashed. So are we in the process of just reliving that experience? Or will interest rates now turn and head lower and that notional amount of negative yielding debt go back up? I'm kind of in favor of the latter for some reasons we can discuss. But that's going to be key to where we go from here.
I wanted to piggyback off of your comments about the increases that happened this year in negative sovereign debt, because we have a brand new head of the European Central Bank, which is a very strange position because it's appointed position. It's not elected, and but it's in charge of the bank for the entire Eurozone. So it's just an incredibly powerful position. So we have Christine Lagarde, who just took the reins from Mario Draghi, and her big quote that came out about a week ago, quote, "We should be happier to have a job than to have our savings protected." And what she was doing, she was endorsing the negative interest rate policy of her predecessor, and saying that it was wise to basically juice the markets, juice the economic, try to re-stimulate, basically, put the paddles and electric shock on the economy there to try to keep things moving rather than to protect people's savings, because negative interest rates are so toxic to people's savings.
Right.
And I was just reflecting on that, and it's like we should be grateful to have work and not be able to keep the fruits of our work. So you just carry that forward to its natural extension, is that you have to work and you're not going to earn anything from it. So you're working for free. So that's what the definition of slavery is, isn't it? And we were talking about that, and it's like, oh my gosh, it's actually being put in our face. People have been talking for a decade now about the destruction of the middle class, and here we're actually being told, you should thank us, your overlords, that we are providing you with the ability to work and not be able to keep what you earn from working. It's just like,
I had
let
not
that sink
heard
in.
Dunnigan, I hadn't heard that. That's outrageous. I mean, think of kind of a frog in a pot standpoint, how we just accept that as normal in 2019, right? I mean, can you imagine going back 20 years ago, where Alan Greenspan or, some other central banker had said something like that? You're just lucky to have a job. I mean, really? I mean, doesn't that fly in the face with, the mantra that we're fed by the mainstream media all the time about how great things are?
Right.
And the politicians, it's great. This is the greatest thing ever. But no, you're just lucky to have a job. You should be able to take these negative interest rates and just be glad that we're able to keep the plate spinning long enough that you can get another paycheck. Right. Basically what she's telling you.
Basically, right to your face, saying we're actually reaching into your savings account, taking money out, and pumping businesses and stocks to keep them going, and you should be grateful for that.
Right, because you're right. I mean, you've had guests on, and me over the years that have said, your savings are in dollars, right? You work hard, you pay your bills, you try to, whatever's left over, you save for whatever, your child's education or taking care of your parents or the upcoming wedding or whatever. And you save in dollars. You're paid in dollars. You save in dollars. Well, when the central bankers and the politicians conspire together to devalue the dollar by printing more and more of them, they're basically stealing from you and devaluing your accumulated hard work and your effort. So now, not only are they doing that, but now the money that you try to save, and whether people use savings accounts these days or what they keep in the bank, whatever, the money that you're trying to save, they're actually confiscating that too. Because again, what do we people wondering what we're talking about here? A negative interest rate, besides the fees, the service charges and the fees for checking and all that kind of stuff. Remember, it used to be you'd your bank would compete with each other. Get 2% on your checking account and a toaster.
Yeah.
Right.
Yeah.
Right. Or maybe you buy I remember back when I was a stockbroker. I used to call up people and try to get them to buy, a municipal bond, at 6%. And they'd say, no, I'm getting a CD at 7 down at, the local bank for a year. And that's what old people, retirees did. They didn't want to take any risk. And so they're just rolling CDs, going around town, checking the ads in the paper. Well, now you have to pay the bank 1% for the privilege of them holding your money. And when we talk about negative rates around the globe, you're paying the issuer of the debt now for the privilege of them giving back part of, most 99% of your money at maturity. I mean, it's madness. But this is the extent of the damage that's been caused by these central bankers and their policies. And we all now just sit back and like, oh, yeah, I guess I'm just glad to have a job. Amazing.
And for that to be the headline statement of the most powerful financially positioned person in the East in the Western Hemisphere there, it's just astonishing that it's right there in our face. The full quote goes on to say, "We should be happier to have a job than to have our savings protected. I think that is in the spirit that monetary policy has been decided by my predecessors, and I think that they made quite a beneficial choice."
Okay. Hey, you're not to sidetrack where you want to go with that, but I would encourage everybody listening to us to check out the words of another European central banker. It was about 2 weeks ago. The guy by the name of Mervyn King, and Lord King is his title.
Okay.
He's a former head of the Bank of England. In fact, he was the head of the Bank of England during the financial crisis. So he's essentially, let's just call him England's Ben Bernanke, okay? And he's now retired like Ben Bernanke's retired, though I don't think he just went to work for a hedge fund making, hundreds of millions of dollars a year. I think Lord King probably is, enjoying his afternoon tea instead. But anyway, Lord King was interviewed by The Guardian newspaper. And so anybody want to do a little homework project, just go to Google or whatever you like and type in Guardian Mervyn, Mervyn King, and read this article. And he was extraordinarily frank. And he said a couple of really important things. One was that central bankers and politicians should immediately begin to meet behind closed doors, is his word, to plan for the next crisis. What meet behind closed? You only do that when you don't want people to know what's going on, right?
Or how bad things are, yeah.
Yeah, or how bad things are. Then he further went on to say, and they actually quoted him as saying this. He said that the global central bankers need to, quote, stop pretending that the banking system is safe. Stop. I mean, I'm not paraphrasing. That's exactly how he was quoted. Stop pretending that the banking system is safe, which is, essentially what they do. I mean, we're talking on Monday, the 11th. Maybe people saw Jamie Dimon last night on 60 Minutes. Jamie Dimon, the CEO of a corrupt criminal organization the organization itself has been criminally prosecuted for corruption, whether it's in mortgage securities or LIBOR manipulation, or now they're going after him for precious metals manipulation. I mean, they've been fined billions and billions of dollars. This is a corrupt criminal organization. But yet here is 60 Minutes interviewing the CEO as if he walks on water.
Elder statesman, yeah.
Yeah, and you would think, I remember, the Mike Wallace days, right? You didn't want Mike Wallace or Morley Safer showing up on your front door, it's like the worst thing could ever possibly happen back in the 80s. But here's Leslie Stahl just fawning over herself. Oh, how great you are, Jamie. Never once did she say, tell me about the billions of fines you had to pay for repossessing the homes of military veterans' families. Could you explain that to me? Mr. No, you didn't get any of that. So anyway, I digress. But we're told about how wonderful the bankers are. Jamie Dimon in that expose being, just one example. When Lord King is telling you that they need to stop pretending that the banking system is safe. That's a rather interesting set of circumstances as well, I suppose.
This week, for the first time, we're going to be having Danielle DiMartino Booth on our channel, and she recently spoke as a keynote speaker at a Stansberry conference on investing in October, and she talked about the inversion of the yield curve that happened earlier this year and how it has infallibly predicted major recessions since 1950, and that they have always started within 11 months to 24 months from that inversion time. And then the further analysis said actually, even though it appeared that the curve didn't invert until May, there was actually, could be backdated to December of last year. And so 11 to 24 months from last December brings us to, if you now look at November of 2019, that means 0 to 17 months from now is about the window you've got before infallibly predicting a major recession. So back to what you were saying about bankers needing to meet behind closed doors to plan for the crisis. She said, "We're on the clock. We are on the clock. It is. We are now in the countdown." And so people have been asking for a long time, "When's the collapse? When's the collapse? When's the collapse?" It's like, well, whether you want to call it a collapse or not, everybody who has weighed in on this, who has analyzed the situation, and so we'd like you to talk to us about it. How are we situated today versus prior to the 2008-2009 financial collapse from a vulnerability, magnitude of the bubbles, derivatives exposure, risk posture, sovereign debts, retirement plan, solvency, etc.?
Right.
How do you see our position currently, our risk posture compared to prior to the 2008-2009 collapse, if we are in fact we're on the clock for the next one here?
Well, it's far worse, just because the math has gotten that much worse. And in responding to the prior crisis, the central banks have already driven us to this point. So it's not like, that's why we're talking about negative interest rates, because it's not like they can cut rates, right? That used to be their policy tool. We're going to cut the interest rate, of the Fed funds rate, and the economy is going to respond. Well, they don't have that. That's why they're ostensibly trying to hike rates a year ago, was to give them some room to cut them in the next crisis. I would encourage everybody to check back and follow your channel, Dunnigan, because Danielle is brilliant. I've spoken with her on multiple occasions, and I'm sure that interview is going to be great. And she's right. That inversion of the yield curve, where short rates are higher yielding than long rates, is almost always a precursor of recession. Also, then coming out of that, when the yield curve starts to uninvert and be positively sloping again, like it is now after the last 90 days, that is typically a sign that the recession has begun. Okay? I'll tie this back together to that forecast I mentioned earlier. The reason why I thought this would be such a great year for the precious metals, and why I said it's the best year since 2010, is I thought it looked a lot like 2010. Because in 2010, we were coming out of the financial crisis, and everybody was talking about green shoots and economic recovery, and QE was this one-off thing for $600 billion, never to be done again. Done again. See what I did there?
Yeah.
Okay, anyway, yeah. See, I'm a pro at this, my friends. Yeah, I usually don't. I just thought I'd point that out. All right, anyway. In the second quarter of 2010, GDP growth was posted at 3%. In the third quarter, it was 2%. And into the fourth quarter, it began to go negative. And in the first quarter of 2011, it was negative. And there's your 2 quarters that are negative in growth, contraction, and that's how you begin to define a recession. Again, I mentioned earlier that I don't think we're on a path like we were in 2016. And one of the reasons why is because we are slipping into recession. 2016, we were beginning to expand. And with the election of Trump, everybody got all excited and confidence took off, and there was going to be all this infrastructure spending, and the dollar was going to rebound, and everybody was, at least half of the political constituency in the U.S. was excited. Well, that's not happening now. And we are slowly grinding into recession. The first measure of third quarter GDP just came out 2 weeks ago. And they were able to goose it up to 1.9% because they said we sold a bunch of RVs, basically. The subcategory of recreational vehicles had this huge growth to it. So they said it was 1.9%. Well, anyway, it's now below 2. We're halfway through the fourth quarter. And both the Atlanta Fed GDP predictor for this quarter is at 1%. The New York Fed GDP predictor for this quarter is 0.7%. So, I mean, you can see the trend, man. I mean, it's going like this. And that's the problem because just think of it. Let's keep it, the most simplest level. Think of government tax receipts, right? The income to the government is the only income they have besides fees and, assorted crap they've laid on there is tax revenue. Well, tax revenue in a declining economy, contracting economy, whatever, falls, right? You don't have as many jobs. You don't have people spending, all this kind of stuff.
Sure.
And so it exacerbates the budget deficit.
Right.
Well, they don't rein in spending. The spending just continues, or they even do more, stimulus, right? So now all of a sudden we've got $1 trillion budget deficit, this year. It goes to 1.5 or 2 trillion. Well, so now you've got to really ramp up the money printing because just servicing the debt on the new stuff that's coming down the pipe, to fund the 2 trillion is a huge problem. The line item on the budget goes from $400 billion a year to $800 billion just to service the debt. So anyway, that's why they've got to keep the plate spinning because as I mentioned, when we started this answer, they don't have a lot of wiggle room from a policy standpoint. I mean, they can force negative rates. They can enforce capital controls so that you can't take money out of the bank. I mean, there's all these kind of things that eventually will probably happen. But these central bankers are desperate to avoid the crisis. And that gets back to what Mervyn King was saying. You can see this crisis coming. Like Danielle DiMartino Booth said, it's just the math. I mean, it's always happened before. So the politicians and the central bankers better get their act together now to be ready for it. And it's coming. I mean, I don't see how we're not contracting next year. And that's going to make things pretty interesting.
Couple of real life, just little anecdotes that correlate to exactly what you just said. One, we have an acquaintance who's managing a large trucking company, and we're hoping to get him on the channel to talk about what he's seeing on the ground as far as what he's describing as the worst contraction that he's seen in many years in terms of actual volume and value of shipments. Secondly, when you said capital controls, I tried to figure out how I could get you on this one, but it was Capital One where we had an online savings account just to get that 2% yield you were talking about, or when we signed up for it. And they sent us this card, which we shared with our viewers a couple months back, where it said right in there, for your safety and convenience, we're going to be implementing transfer restrictions on the amount that can be moved out of your account. And we will we will set the limits from time to time as we deem associated. But we're adding this to your account as an additional safeguard for you or something. And it's like, holy smokes, we pulled out all of our money out of that and shut that account down completely. Once that we got the heads up there that, hey folks, we're taking over we're restricting your ability to access your funds, and we'll do it whenever and at what extent we choose, but it's for your own good.
All right, so now this is where, if you have the ability, you edit in that snippet from South Park where the little guy takes in his $100, he gives it to the bank.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
And it's gone. The guy, he's like, here's my, and it's funny, but here's my check. I got all my savings. He goes, thank you. We're going to put it in some, international money market fund, blah, blah, blah. And he's typing away, banging on his keyboard. And then he just goes, and it's gone. What are you talking about? It's gone. So look, this gets to, in the end, the message of your site and your channel. Done again. This is self-reliance. You gotta be paying attention, and you don't want to get caught flat-footed and go to the bank and have the bank tell you, no, I'm sorry, we can't have a run it, because all these banks they're set up on a fractional reserve system. We're coming up on Christmas time. You're going to see the perfect cinematic illustration of that when you watch It's a Wonderful Life again this year. Remember, on George's wedding day, everybody shows up at the building and loan wanting their money out, and George got to explain to them that he's only got about 10% of their cash in the vault.
Right.
That's a system that we work on still today. So you've got to understand, look, the sky's not falling, right? We're not saying this is all going to happen tomorrow. but you can't just sleepwalk, and whistle past the graveyard either, and I'm just telling you, I mean, somebody listening to us, when all this happens, and, if it gets to the point where there's a bank holiday and the ATMs are closed, that kind of thing, which is, not inconceivable. And you don't have any cash on hand, or you don't have any physical silver or something like that, you're going to sit back and go, God, all those years I watched Dunnigan's new YouTube channel and I didn't do anything about it. You're going to feel like the dumbest person on the face of the planet for not listening, not preparing. So, this with the old biblical thing, you got to cut hay while the sun is shining, right? You got to get the crops out of the field before winter. Winter's coming. And
maybe we should take the advice, as you mentioned, that was revealed by a person who is in an elite power position, to get behind closed doors and make plans for the crisis.
Right.
Maybe we should take that advice.
Right, exactly. That's exactly right.
Can you talk to us about why, and you've tweeted about this pretty regularly recently, about these smash downs that have been happening at an amazing high volume number of contracts, that kind of thing, but why this month in particular? Why is this an important month for the direction of precious metals to be affected?
Well, the price is largely determined through the trading of these futures contracts, right? I think most folks realize that now. The fundamental stuff has maybe a minor impact, like when you read about Turkey buying a bunch of gold in the third quarter, and stuff like that. But what really determines price is supply and demand of those futures contracts. Well, right now we have an abundance of supply. In fact, the record amount on that exchange in New York where the futures contracts are traded, what's called the COMEX. The total amount of available contracts now is more than it's ever been, ever. More than 2011, more than 2016, all-time highs. And the way that market operates, the vast majority of those contracts, usually 65%, let's just call it 2/3, are in what's called the front month, the month that's closest to going into what they call delivery. I don't know what's the best way to explain that. But anyway, most of that volume, most of that open interest contract volume is in the nearby closest month. Well, right now that month is December, the December gold. You'll see that quoted on Bloomberg or CNBC. And the December contract, where all that open interest goes off the board and into delivery in about 2 weeks. So what happened? Nobody takes delivery. So what happens is all those positions that are in December are going to get closed out and switched into the next front month, which is February. All right. So this can be an orderly process where there's not that much impact on price, where maybe you've got 100 contracts of December gold and you don't want to take delivery, and you don't have the margin to do it or anything like that. So you sell your 100 contracts in December, then you immediately turn around and buy 100 contracts in February to maintain your position. Net impact on price is nothing, really. But in a declining market, you might, because everybody wants to buy it cheap, right? You might take off your 100 in December and then go, I think I'll buy 50 February. And then I'll wait to see if price comes down and I'll buy another 50 later. Well, that's a net selling impact of 50 contracts. I think that I think that's
sure.
Understandable. Okay, so what we do, how many of those contracts directly roll, we'll see. What we do know is they have to roll, right? You've got to be out of, there's still 450,000 contracts of 700,000 that are in December. And that 450,000 is going to go to 10,000 over the next 2 weeks. So we're going to have a real period of volatility here over the next couple of weeks. Then we're going to get into December, and then we're going to kind of move through some tax loss selling and that kind of thing. But I think it's going to end up being a good month. We'll rally back to this area that I first started writing about in January, around 1480 or 1500. And that's probably where we'll finish the year. And then the calendar flips to 2020, and then we got to start looking ahead to, well, what's going to happen this year? Are interest rates going to keep going down? Is our economy going to continue to slow? Or is suddenly they're going to be a boom again and interest rates going to go up? And if you can answer that question, you can probably figure out where metals are going next year too.
Could you talk to us for a moment about the bond repo action by the Fed and what you think it signifies about the health of the financial system right now, the banks and their ability to provide liquidity, that gets them through overnight?
Yeah, well, this is a relatively new problem. It first appeared in about the middle to the late stages of September. Basically, think of it as banks loaning money to each other on an overnight basis. If you're a bank and you just don't have cash reserves on a certain day and you need $10 billion, you go borrow it from another bank. And that bank says, okay, yeah, here's $10 billion. And then the next day you've got the cash reserves back. And so you've got your $10 billion, you give it back, to that bank that you borrowed it from. It's just like a one-day loan, right? And as part of that loan, you put up collateral. You've got treasury bonds on your books. So you put up collateral, they you journal that over to the other Bank A, and then Bank A sends $10 billion to Bank B, and then they swap it back and forth. Well, anyway, the end of September, Bank A suddenly didn't want to loan to Bank B anymore, would be probably the simplest way to put it. And so there was this liquidity shortage that appeared. People said, well, it just has to do with the end of the quarter and tax payments and all this kind of stuff. Well, then we got in October and it got worse. And then finally, in the middle of October, the Fed steps up out of the blue and says, not only are these, because the Fed became the Bank A, they took over as a lender of last resort in these transactions and said, okay, come to us. We'll take your collateral and we'll give you. If the other banks aren't willing to do it, at least we'll do it as a lender of last resort. Well, because it wasn't getting any better, the amount of dollars that the Fed takes in, they have a cap on a daily basis, it just continues to get expanded. It's now up to $120 billion on any individual day basis. So what's going on here? Why is there this shortage of cash? There's really only two reasons. One, the banks for some reason don't trust each other. Now, it could be some people have floated that JP Morgan has blown all their cash, buying back their stock and stuff like that, and they're the one that needs the cash every day. Maybe that's it. The other, then there's, I guess, a second reason, and that is somebody like a Deutsche Bank is considered to be a bad risk, and people don't want to do business with them. Oh, sure, you can give us, we'll take your collateral, we'll give you the money, but we're worried about getting the money back because we don't think, Deutsche Bank, you'll give us the money back tomorrow or 2 weeks from now. So that's option number two. And then the third option that explains this is just a lack of cash, that the government is issuing so much debt now. We got to the end of September. There'd been the debt ceiling that the government wasn't issuing any new debt, for about 60 days. And all of a sudden they flooded like $800 billion out in 2 months. And these big banks are what are called primary dealers of treasury auctions, which means they make a lot of money, but also means they're the buyer of last resort in treasury auctions. And so what might have happened in September and October is all this rush of treasury issuance came out, and these primary dealer banks like JP Morgan used up all their available cash supporting the treasury market. And so now there's no cash, and that's why the Fed's got to step in and provide cash every day. So it's one of those three, really, is about as simple as it gets. I don't know which one it is, but what I do know is it ain't going away. And this is now, like I said, the Fed just keeps increasing the size of that daily repo action. Yeah. Now, and furthermore, all of a sudden they're buying treasuries, treasury bills less than 1 year to maturity. But now they've begun this new program, $60 billion a month of U.S. debt that they're going to monetize. So maybe this is all part of what old Mervyn King was talking about. Maybe it'll all just go away. 6 months from now, it'll all go away and, things will go back to whatever normal was as recently as August. But this is something, again, people need to keep an eye on. If there's a real liquidity problem, that's going to impact the bond market. It's going to impact the dollar. It's eventually going to impact the stock market too.
Just from the common man's experience, I'm just thinking about when you talked about the potential of banks not being willing to lend to each other and wanting to hold tight to their cash and not let that get out the door. It just reminded me of playing the game of musical chairs as a child. And as you're walking past each chair, you linger and you linger and you linger and you dash to the next chair, and then you linger and you linger, dash to the next chair, because for gosh sakes, you don't want to be the one to be stuck where the gap is, where there's no chair, but when the music stops.
Yeah. Yeah, no, and that's right. And you think of, from a banking perspective, if you trust the people that you're interacting with, okay, then fine. Yeah, we'll make this arrangement at 2% interest or whatever is what generally those repo rates are. But when this first took off, those repo rates went to 7, 8, 9%. Again, that's a lot of. That tells you right there. There was a shortage of cash, but that made you think somebody's not trusting that they're going to. Okay, sure, I'll take your treasuries and I'll give you my cash, but I'm going to charge you this exorbitant interest rate because I'm that worried that you're not going to give the cash back tomorrow or 2 weeks from now. And again, this came from out of the blue and was written off as being, just a temporary, don't worry, it'll ease by the 1st of October. And now Here we are, November the 11th, and it continues.
And they're going to keep going on into January. So
no, at least January. Yeah, that's for now. I think they go at least through January, at least in the first quarter. And the Treasury buying is slated to continue through June. And most folks think, that it's not like the funding crisis, the U.S. government's going to go away. And so this has probably become a permanent debt monetization. They're monetizing the debt, right? The government issues the T-bills to collect money to pay the debts, and fund the deficit. The money's got to come from somewhere. And so it's just being printed by the Fed now. That's debt monetization is what it is. And that's kind of the end game.
Craig, if people want to find more of your work, where can they find you online?
Well, we talk a lot about the precious metals, obviously, but it's pretty clear that's not all we talk about. We call it the end of the great Keynesian experiment. And Keynes being the economist that kind of was the godfather to all this current madness back in the 1930s. And it's the end of the experiment because at some point the math just overwhelms. You just can't create money fast enough. You can't grow your economy and thus your tax receipts and stuff fast enough to maintain the system. You just end up just blows up like every other fiat money experiment has blown up. Think of Weimar Germany. So anyway, this is what we talk about every day at TFMetals Report. I do my analysis. I like to think there's some value, but really, the value is in the site itself and the people from all around the world that interact there. Yeah, it's $12 a month if you want to join. I think it's money well spent. Check us out, TFMetalsReport.com.
Hey, before we let you go, can you stick around for one more minute for a bonus question for our Patreon supporters?
Lay it on me, baby.
Well, for those of you who are not yet supporting our channel on Patreon, it's so easy. You go to patreon.com/reluctantpreppers. For any amount, you can sign up and support us on a monthly basis. It allows us to be free and independent from censorship that comes from corporate ads that we otherwise are subject to on YouTube and so on. And it allows you to get access to bonus content from many of our guests that we've had on. So, Craig, just thanks for joining us on this main interview here on Reluctant Preppers and Financial and Liberty.
My pleasure, my friend. All the best.
Bonus footage from other guests we've had on. Come on over right now to patreon.com/reluctantpreppers and access that bonus footage there. Take care.
It seems so hard to order. Who can I trust and how do I even start?
Oh, you just go to sdbullion.com/rp, pick out whatever gold or silver you want, add it to your cart, you can check out, and it's on its way. And they're A+ rated by the Better Business Bureau.
Wow, it's that easy?
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
After I order gold or silver, how can I trust I'm going to get it? And I don't want everybody to know that I'm ordering gold and silver.
Oh, it's okay. It's fully insured. It's trackable, and you have to sign for it, so nobody else is going to get it but you. And it comes discreetly packaged. If you order a small amount, like maybe gold, it'll probably come in a box that looks something like this. Okay. And if you order a large amount, maybe like silver, it'll come in a box that looks something like this.
Wow.
But it doesn't say gold or silver on there. It might say something industrial or something else like that, but nobody's going to know what you ordered.
Oh, that's great to know.
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
If I own gold or silver, how will I ever be able to spend it?
Oh, sure. Well, consider good times or bad times. Like in good times, you can sell it back to the same place you bought it from. sdbullion.com/RP will buy it back at the best price guaranteed on the internet. You can take it to a local coin shop and get cash in your hand, completely anonymous. Some people you know may be willing to take gold or silver coins in exchange for goods or services. Now, in bad times, when things have really fallen apart, time after time in history, people have found that in hard times, gold and silver really does come through as something that people recognize as value even after everything else has failed. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
What if gold or silver drop in price after I order it?
Well, everything fluctuates with time, but nothing has held up longer and better than gold and silver throughout all the changes that have happened in history. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP.
What good does gold do me anyway? I can't use it for anything.
Well, I think I found a form you might appreciate.
Wow. That's beautiful. Wow, I can wear that just about anywhere.
And you can take it with you through airport security and across borders. It's small and compact and lightweight, and you can even hand it down through generations. Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.